Thanks, Lars, and thanks to the organizing committee for having me. It's a real privilege to be here. I'm going to talk about the credit-driven household demand channel, and this is work with Amir Sufi. The basic point is going to be that this channel that I'll describe in a minute, it's really important for understanding business cycles around the world, not only in the most recent recession that we experienced in 2008, but also more broadly looking at historical data. And it has, that fact itself has important long-run implications. I'll try to highlight that when we think about where the global economy is heading going forward. So let me start with what I think is sort of the key empirical regularity coming out of the Great Recession, which you can see in this graph where I'm showing you states within the US sorted on the x-axis by the growth in household credit to GDP from 2002 and 2007. And what you can clearly see in this picture is that there is a very strong positive relationship between the run-up in household credit to GDP and then the severity or the extent of the recession that a given state experienced between 2007 and 2010. What is equally remarkable is that this relationship that you are seeing within the US is essentially as strong when you look at across countries for the 2008 episode. Again, literally the same two variables, and what you find is essentially the same relationship across countries. That is, countries that saw a larger expansion in household credit to GDP, they end up experiencing a much more severe recession. Now, you might say that I'm conditioning on a recession here, but as I'm going to show you next, this kind of relationship that you're seeing, it holds more generally. And number two, you don't have to condition on a recession. This relationship actually holds unconditionally in the data as well. And I'll, again, emphasize that as I go along. So the obvious question when you look at this kind of data is what is behind it? What is the economics of the channel that is driving this relationship? And that's where I'm going to emphasize the title of my talk, that is credit-driven household demand channel. We feel that this is the mechanism that leads to this kind of strong pattern in the data that we see very clearly. So what is the credit-driven household demand channel? It basically begins by, with something that looks like a credit supply expansion. All else equal, for the same loan applicant, the financial market is just willing to lend more. The next thing that happens is that expansion in credit supply leads to an expansion in local aggregate demand driven by the household sector. That goes on for a while, but this initial expansion in credit supply essentially sows the seeds of its own demise, and ultimately there is some kind of a crisis and a slowdown in GDP growth. To again come back to the very first stage, you see it very clearly in the data that typically an expansion in credit supply eventually ends up predicting a slowdown in GDP growth. So let me now show you some data to essentially illustrate this point, and I'm going to do this in three different ways. I'll start with the broadest evidence, which is the cross-country international evidence. Then I'll talk about a natural experiment from the US in the 80s, and then followed by the 2008 episode. So this is the international evidence. And first, to summarize the basic fact, what we are doing here is we are pooling 30 largely advanced economies, about 50 years of data, so the last half century, so to speak. And we run a simple VAR between the two main components of private credit, household and non-financial firm, and real GDP. And what you can see is that there is this clear boom-bust relationship of GDP in response to a shock to household credit. There is this initial boom, but most importantly, that's the negative predictive relationship that I was talking about earlier. After about 3 to 4 years on average, in response to this initial expansion in credit, you see a slowdown in GDP growth. Now, interestingly, there is this asymmetry between response to household credit and a response to non-financial firm credit. The second component of private credit does not have the same relationship that you see in household credit. So let's look at this relationship between these two types of private credit and the business cycle a little bit in more detail, and I'm going to do that in this table. Again, the same set of countries. And the first thing I would highlight here is that when you look at the contemporaneous correlation of these two components of credit with the economy, what you find is that during the credit boom, so these are 3-year differences in household credit and firm credit, during the credit boom, there is essentially a consumption boom in the local economy. Consumption to GDP ratio goes up, net exports go down, so you import a lot, and what are you importing? Is the consumption good share of imports that rises. So you're not importing capital goods, which you might for investment purposes, but you're importing consumption goods a lot more. And again, interestingly, there is that asymmetry. These facts of consumption boom, they correlate with the household credit boom, not with the non-financial firm credit boom. Now, I mentioned that this credit supply shock, it moves the aggregate demand curve outward, right? How do we test that? The idea that we have is that if the expansion is on the local household demand side, then it should disproportionately impact the non-tradable sector, because that sector, by definition, depends on local demand. So you should see the local non-tradable sector expand relative to the tradable sector, both in terms of its size, but also in terms of the price of non-tradable to tradable sector, because there is more demand now. If it were a supply shock, you would expect the shock to be deflationary, but since this is a demand side shock, the hypothesis would suggest that we should observe a real exchange rate appreciation, if you like, as well. When we look at the data, we see exactly the same result, which is that you see this expansion in the non-tradable to tradable sector in response to this household credit shock. And again, notice the asymmetry. There is no such relationship for non-financial firm credit. Last point, as I mentioned before, is the future GDP growth predictability. Looking forward in time, the shock to household credit leads to a slowdown in GDP, no such relationship for non-financial firm credit. Okay? Now, when we did this study, it was 2015. It took a couple of years to convince the editors to publish this. So these results are from that 2017 paper. Since then, in fact, just this month, the IMF has published a new global debt database. And in that database, they expanded the number of countries for which we now have household credit and non-financial firm credit. So, and that's about 105 additional countries. So just for the Nobel Symposium, we did a real-time out-of-sample test. We took those 105 countries, it's data 2000 onwards basically, and we essentially replicate our earlier regressions. I'm just going to show you one, which is the key one, slowdown in GDP, and that one is in red, only focusing on the new sample, that's the 105 countries. So again, out of sample test, you essentially find very similar results, okay? Let me show you, again, just to emphasize this result once more, let me emphasize on the non-parametric, just the bivariate relationship between these two key variables. On the x-axis, I have household credit to GDP expansion, t minus 4 to t minus 1. On the y-axis, growth in GDP, t to t plus 3. You can see this negative relationship. That's the one I've emphasized. This is the original 2017 paper, and the red line is the out of sample. It's kind of straightforward. The relationship is there. But the other point I want to emphasize is that it's also nonlinear. In other words, it's not the case that a reduction or a deleveraging leads to GDP growth. That would be kind of strange, right? It's just, it happens in one direction only, which is consistent with the theoretical models we have, like downward wage rigidity, zero lower bound. Those constraints should only bind in one direction and not the other, and the data are very supportive of that. Let me now move to this natural experiment, right? If you're an empiricist like Amir and I, you want a better instrument, if you like, for credit supply shock. And the most well-known natural experiment for credit supply shock at the macro level is the 1980s banking deregulation that was earlier mentioned as well. You basically have, well, everybody's from the US, as was mentioned, so we all know what banking deregulation was. But very quickly, states that deregulated earlier, they see a much stronger expansion in credit, and you can see it in this graph. This is the first stage, if you like. Early deregulating states, they see a much larger expansion in credit, including household credit. So now let's start looking at the outcomes, just by sorting states on this margin of the timing of deregulation. And the first thing I want to emphasize is that this credit, now we can think of it literally as a credit supply shock, right? If you had some doubts before. What you see in response to this shock is you see this boom-bust pattern. The early deregulating states, they go through a period of boom. Unemployment rate falls much more aggressively. But then when the recession hits, it's more severe in the early deregulating states as opposed to the late deregulating states. So again, consistent with this boom-bust VAR evidence that I showed you earlier, you see the same pattern in this, as I said, very well-known natural experiment as well. Let's dig into this a little bit more and look at this hypothesis that it's driven by expansion in aggregate demand. And again, I'm going to use the same trick of looking at non-tradable versus tradable sector. Focusing on the expansionary phase of the cycle, what you see is, I should say, I'm sorting the states on the x-axis by, again, the timing of deregulation. So if you are a state on the right, you deregulated earlier, and hence you are experiencing a stronger credit expansion, right? What you can see is that states that deregulate early and hence have stronger credit growth, they have a significantly stronger growth in the non-tradable sector, as measured by employment in the non-tradable sector. Interestingly, and somewhat remarkably, there is no such relationship in the tradable sector. Again, using the earlier logic, this suggests that this is an expansion on the demand side primarily, as opposed to an expansion on the supply side, which would have suggested expansion in all kinds of sectors that relied on bank credit. Let's look at prices. This is just a quantity dimension. We can look at prices as well. And again, you see the same picture. Expansion in non-tradable prices, not so much on the tradable prices, right? So again, substantiating this idea that this expansion is driven by aggregate demand. This is the final graph I'm going to show you on this natural experiment. And notice that this graph essentially looks identical to the very first graph that I showed you, which was for 2008. Now looking at the 1991 recession, I'm sorting states by household leverage to GDP growth during the boom phase, 82 to 89. And on the y-axis, I have the depth of the recession. And it's quite amazing that they kind of look identical to the 2008 graph that I showed you. The extra advantage we have now is that we have an instrument for the x-axis, which is again the timing of the deregulation. So there is something, the point, and one of the reasons I'm emphasizing the 1980s here is that I do want to convey this point that 2008 was not a unique event. Stuff like this has been happening before, we just didn't pay as much attention to it for one reason or another. Let me now come to the US during the 2000s. There's a lot of work, and Amit has a very nice paper on this as well, documenting expansion in credit supply during the 2000s. Right? Spreads go down, quantity of credit goes up. It's kind of quite straightforward. We also know, this is one paper, for example, that during the boom phase, there is this expansion in housing sector, in the non-tradable sector more generally, so it kind of looks like an aggregate demand boom as well. I've already talked about that, so I won't beat on that point more. What I will focus on a bit more for the 2008 crisis is what happens during the bust. And kind of the theory of this mechanism for the bust phase of the cycle was given very eloquently by Irving Fisher, who called it the debt deflation hypothesis. So what happens here is households that have levered up a lot, in response to a negative shock, they cut back on spending once they realize the balance sheet position. And that's kind of the initial trigger of this shock, is the fall in demand. That fall in demand then hits the local employment. People start getting fired, which obviously feed further into the negative demand, the initial shock. But the other thing that happened, and this channel was very important for the US, and was kind of one of the, I would say, the policy failures as well, was that high leverage and a slowdown in the economy leads to fire sales and foreclosures en masse. Over 4 million foreclosures, for example, in the US, which further hits house prices, and this kind of cycle feeds on itself. Let me show you evidence for these mechanisms. I won't have time to talk about the foreclosure externality, but we have earlier work documenting that as well. This is the evidence on this idea that high leverage leads to this fall in demand. So what I'm showing you here is each circle is a county in the US, and the size of the circle is the size of the county. And I'm sorting them by essentially the household balance sheet shock that households on average are experiencing in that county. It's a change in housing net worth. Essentially, it's a product of the leverage that they have times the decline in house prices. And of course, those two are interacting because of that vicious cycle that I talked about. What you can see very clearly is that counties that experienced a stronger negative shock in household net worth, they have a stronger decline in spending during the Great Recession. This decline in spending then translates into a fall in employment as well, because clearly employers depend on this demand for hiring workers. And you can see that by correlating the same shock on the x-axis with fall in non-tradable employment, which by definition, again, depends on demand from that county. And you can see non-tradable employment fall more in counties that are being hit harder. To kind of confirm that this is a local demand channel, we again use this idea that tradable sector should not respond as much to the local demand shock because they rely on demand everywhere. So when you look at the same relationship for tradable goods, you again see a flat relationship, not a downward, not an upward sloping one. Now, of course, that doesn't mean the tradable sector is not affected. They're affected by the integral of all the counties, and so it's the level that drops for the tradable sector. You don't find this cross-sectional relationship. So again, this is to suggest that this local demand channel is quite important in explaining the bust. All right. Hopefully, I've convinced you by now that this credit-driven household demand channel is important, relevant, historic. It's not just a 2008 phenomena, happens everywhere, including the 35 countries and the 105 that came later. Let me now discuss very briefly some of the theoretical and policy implications of this. I'll start with the theoretical one, and I just want to mention kind of three main points. The first one is that heterogeneity matters. I think given this link between finance and business cycles, it's clear that we need to take seriously heterogeneity, and in particular, heterogeneity across borrowers and creditors. We can actually estimate that heterogeneity in the data, so we have done that in a couple of papers. This is estimating marginal propensity to spend in response to a negative household net worth shock. And what you find is that households that are much more levered, for the same dollar decline in housing net worth, they respond much more aggressively compared to a less levered household responding to the same dollar decline in housing net worth, right? So this heterogeneity is very strong and clear in the data. You also see it during the boom phase in terms of how aggressively people borrow against a dollar increase in home equity. And again, for the same dollar increase in home equity, if you are a high credit score individual, typically that also means you're wealthier, richer, you're saving more, you're basically the creditor. You don't respond much. In fact, you're not responding at all to increase in home value. It's the lower credit score individuals who respond much more aggressively to the increase in home value. So heterogeneity is very important. The second point, by the way, I should highlight this. Obviously, we are not theorists. So here, there's this wonderful work. People in the audience, Gauti, Emmanuel, Veronica, Guido, Schmidt-Grohe, and Uribe, all of these papers, they basically exploit these facts, focus on the heterogeneity, and then interact that with macro frictions such as zero lower bound or downward wage rigidity to generate these amplification cycles that I just talked about. Now, one point that I want to emphasize, which I think is very important, and it has been emphasized very nicely by John Giannakopoulos and Janioli, Schleifer, and Vishny, among others, and Jeremy also has a related paper on this. And this idea is that to understand the kind of facts that I've shown you, it's not sufficient to rely on a model with rational expectations and common beliefs. And the basic reason for that is that this negative predictability that I showed you to be kind of very pervasive in the data, people don't, or I should say, markets and people kind of don't get it. right? That there is that tension. To put it differently, you can predict forecasting errors. For example, of IMF GDP forecast by the same credit growth variable that I talked about. So that suggests that we need to move away from that kind of a framework to explain this particular feature of it, and that's where models such as John Gee's model of heterogeneous beliefs is kind of very important and very central for understanding the connection between credit markets. And similarly, other behavioral biases like neglected risk or diagnostic expectations that other authors have emphasized, those are potentially important forces to think about. The third theoretical point I want to make here is, and this is more looking forward, and this, Alan Taylor is going to come shortly. I've been focusing on the cycles, but there is kind of a super cycle in the background, which is probably the elephant in the room, which is credit has expanded since the 1980s enormously, kind of a secular long-term trend as well. And that also looks like a credit supply expansion, because the price of credit, which is kind of the interest rate, has fallen, while quantity has expanded massively. So there is this, again, this kind of super cycle in the background, which looks like a credit supply expansion. And this question is, what's driving that? Or what's driving credit supply in general? Now, things like financial liberalization, deregulation, I use an experiment, all of that stuff is important for generating local credit supply expansion. But they might also be this global cycle that we need to think about more carefully. So in more recent work, we are trying to look into that connection more carefully. Here I'm just showing you one teaser plot. This is using the tax return data, the kind of the size data, if you like, and constructing household debt series using that, since people report interest expense on their taxes. And this is the usual 1%, 99%. And what you can see is that the run-up in household credit is basically, it's not a top 1% phenomena. That's where all of the income gains are going, but that's not where the credit is going. So that's something that is worth exploring. I think it has deep implications for understanding the very low real interest rate, as well as this sort of stagnation in growth rates that we have seen more recently. Let me just end. How much time do I have? I have
3 minutes.
3 minutes, okay. So let me just end on some of the policy implications of what I've just talked about. The first couple of policy implications, and this is something Amir and I tried to talk about in our book as well, is that risk sharing really matters. Again, because everything is about this tension between creditors and borrowers. So risk sharing really matters. First, from an ex-ante perspective, putting, and Martin mentioned this, on macro risk, putting state contingency in would be really, really useful if we can work in that direction. And we need to think of a regulatory framework, whether it's taxes, for example, interest deductibility, or whether it's Basel regulation. We need to think of how that impacts this trade-off of more equity versus not like contracts. The other implication is, and this was more a criticism of ex-post policies that were undertaken in the US as well as Europe, there was a lot of focus, and for the right reasons, on market liquidity and solving the banking system. But there wasn't as much emphasis on solving the household balance sheet problem, in particular the foreclosures that I talked about. That's just one example of kind of a missed opportunity when the administration had a lot of leverage with the banks. They could have done that. The other couple of points I would make is that this household channel also has important implications for monetary policy pass-through. And Amit Seru, with an army of co-authors, has a very interesting paper where they basically show that underwater homeowners and others who can't refinance very easily, they kind of mute the pass-through channel of monetary policy in tough times, something that we need to be mindful about. And more generally, there is this notion that macroprudential matters not just for the banking sector, but also for the household sector. So a number of countries, UK perhaps being the most prominent example, they have since the crisis instituted debt-to-income, loan-to-value macroprudential regulations to try to limit some of this risk of household credit. So that's all I have. I've tried to convince you about the importance, but if you are still in doubt, I have one last piece of evidence that I want to show you, which comes from the Bank of Sweden itself. And that hopefully will convince or remove all remaining doubts. It's a bit of suspense. And that's this. So even Bank of Sweden now is worried about this rise in household debt in Sweden itself, and all the evidence suggests that it is something that we need to be mindful about. Thank you very much.